Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. One p.m. on the East Coast, Tuesday, January 9th. I'll start by saying this. I'm a little worried about the New York Rangers. Got throttled. And yes, I chose that word throttled last night by the Canucks of Vancouver, who are one of the best teams in the league. But, you know, that's the benchmark now for the Rangers. And they haven't played well for the better part of a month. I'm worried about their netminder, Dan, as are you. As is, by the way, John Butters, who is joining us today. O.M. frickin' G. How are you, Dan?
I'm doing great. I mean, it's not even Thursday. And it's Butters here on Market Call. And we're going to do a deep dive and a little Q4 earnings preview from John Butters with not even released charts and data that are going to drop in his earnings insight.
What do they call that? Like embargoed or something?
Yeah, they're embargoed. So we have this embargoed data from Mr. Butters here. So we're going to check out all of that, guy. But we got a lot to do today on our Market Call, don't we?
It appeared as, listen, yesterday... The S&P's up a cool 60 handles. Like that's a big move. And then today it appeared as though we're going to give some of it back, and the market is fighting itself back to effectively unchanged in the S&P. Everything to me is just, you know, after the S&P, everything is this conversation. The Nasdaq's up small. The S&P's, the Dow's down maybe less than 0.5% now. But again, the S&P is fighting back to unchanged, which is pretty impressive given where we started the day. But there are a lot of things out there, so let's take a look quickly at our rundown. I always like saying Marko Kolanovic for some reason. I don't know why. It sounds like a colonic or something, the things you take to sort of help things start to move. But he thinks things are going to move on the stock front. Yeah. And, you know, it's funny. We talk about some of these semis, and other than some of the big shots, there have been some warning signs, and we're going to talk about some of the warning signs that some of these less talked about semis are telling. And then obviously we mentioned the great John Butters earning preview. That's what we're looking at today. Today, obviously, through the lens of the CME, Dan.
Yeah, let's look at the S&P futures while we're here, just to talk about the markets really quickly here, because to your point, Guy, you know, yesterday, a big reversal after a pretty weak first week of the year as far as markets were concerned there. We didn't get back to that breakout level that you and I were kind of focused on, that 4,600-ish or so. You see that rising 200-day moving average. And again, you know, it's pretty simple here. That gap, and I think that comes from that kind of mid-November period, right, Guy, where we had that CPI print that got things going. And, you know, that was an up 2% to new 52-week highs. Pretty impressive, and brings us to the Marko Kolanovic call that you were talking about. He's expecting negative catalysts here, you know, and those would be the sorts of things that I think if rates which have firmed here a little bit at 4%, if we were to start to see hotter data, that means higher for longer. But talk to me how you're reading what Marko is saying about the disinflation thesis is likely to be challenged in the first half of this year, Guy.
Yeah, well, there are a lot of things to take away from this. And I agree with him in terms of, you know, I still think there's some inflationary pressures out there that the market's not taking into consideration. But whether it's deflation, disinflation, or outright continued inflation, the market faces headwinds. And what I take away from this is, you know, Marko he's dug his heels in on this thesis, but basically an overall negative thesis for quite some time. And like Doug Cass points out, and I think you've said it as much as well, the higher the market goes, it's not changing the things we're concerned about. Like the market strength doesn't fix the ills that we're looking at. It just masks them to a certain extent. And I will tell you, and I think I can't speak for Marko, but I think he would say, and you've said this, Dan, the higher the market goes, the more concerned you get because the market isn't correcting what we're concerned about.
Yeah, no doubt. And to his point, all the things that you know, they have been, you know, the market, you want to say disregarded in 2023, they still remain. And the longer they're out there, they actually don't get much better. Let's look at the 5-year chart of the S&P 500 minis futures here. And this is, I think, what you're probably particularly worried about here, Guy. Yeah, we've gotten back to that prior high here. We've gotten back to that level in a very short period of time, right? If you think about it in about 2.5 months or so, and in a straight line, right? So we're contending with that prior level, as our main man Carter would say. And so that's why I think our conversation with John Butters and expectations for earnings, expectations for first half guidance, especially with, we've been tracking Butters' work on what consensus is for S&P 500 earnings for 2024. They're expected to be up 11%. That's after basically flat in 2023. So that's why this earnings period could hold the key, in my opinion, whether we have the ability to break out. But like, again, you and I thought a check back towards 4,600, maybe even as far as 4,400 might give the basically, might start discounting what might be able to come later on in the year. But until we do that, I'm just hard pressed to think that we can make a meaningful new high from here, Guy, and establish a new range above 4,800.
I think at these levels with the market, you talk about the market being a discounting mechanism, which, we've heard thousands of times over the years. But right now, the market is pricing in just about every positive catalyst that can happen or has happened, or the belief that it will happen, into consideration. And again, I think there's this misguided belief that if the Fed were to start to cut rates, that is somehow bullish for equities. I understand the one-dimensional thinking, but if you go back and look over the periods of time, the market gets its diciest when the Fed starts cutting. Now, people will say that that's because the Fed is cutting when things are going wrong, when things are going pear-shaped. And in this scenario, they will have the ability to cut because things are still going well and inflation's under control. That's sort of the bull case. I just don't sort of see it that way, Dan.
Yeah, well, I mean, listen, Fed Chair Powell said it. They're going to cut before they get to their 2% inflation
And that was,
target.
Yep.
And listen, and this is what Marco is basically saying. He just thinks a lot of the progress with disinflation has been done. Listen, we're going to get some inflation readings in the not so distant future here. But I think it's important. Let's look at the 10-year U.S. Treasury yield. And obviously, it's a fairly pronounced downtrend from that move from 5% a couple months ago. It's obviously corresponds with the actual inverse move that we saw in the S&P 500. You see it's contending here with its 200-day moving average. You know that, we have made a bearish or detailed a bearish trade in the TLT in the next month or two, playing for higher yields here. I know that's been your view. We check back to a technical level, but it really comes down to, you want to put together some qualitative stuff with some quantitative stuff. If we start getting readings, and I think the jobs report on Friday was supportive of this. I mean, it's not like we are going to get softer data that much quicker right now in the near term, which means that rates are likely to stay at least bid above those recent lows at 3.8% in the 10-year, which at some point, if the earnings data or the guidance, the visibility about earnings guidance doesn't look particularly sound, then that should, I think, speak to lower equities, in my opinion, Guy.
Rates seemingly everything is predicated on rate moves. And again, I don't know necessarily the mechanisms of the market anymore. I mean, so many things are driven by algorithms and machines and the interpretation of data and those types of things. Like, I'm hard pressed to believe there are even humans making decisions at any point. But I'll say this, it's pretty obvious that the market really enjoyed 10-year yields going from 5 down to 3.82%. And they're sort of bucking the trend here with this little move higher in yields, to your point. Maybe, I don't know really why the reason is. Maybe there's just discounting the fact that we're seeing a bit of a bounce here in yields before we take the next leg lower. But to your point, I think if yields will start to move in a meaningful way back up towards 4.25%, I think that's when the market takes notice. And again, you outlined a bearish trade in TLT. So basically thinking that yields were going to go back higher a week and a half, 2 weeks ago. And that was within a day or so, I think, of the low in yields and basically the high in the TLT. The TLT has come off markedly since. If you want to throw a TLT chart up there, Jacob or Steven, just to take a look, you'll see. I mean, the move lower has been pretty dramatic over a very short period of time. But I absolutely believe that yields hold the key. And I'll say this as well. If we get to February and with each passing day we get closer, with the market, with the yield curve being inverted, it'll be the longest since we've started taking this data in terms of the economy. And history suggests the longer the inversion the more severe the downturn is. So just be aware of what's out there, folks.
Yeah, and one of the positives that you mentioned, this perception that obviously lower yields are when the Fed starts to cut, that should be good for stocks. We've presented plenty of data going back the last 30 years or so where that actually hasn't been the case. It's from the pause of the rate hikes, right, and that period between, and then when the cuts start happening, things kind of happen all at once. If we just want to look really quickly at the CME FedFunds tracker here for the Jan 31 meeting, you see there's a near certainty, at least the market is pricing the fact that there will not be any cuts. If we want to look at March, it's basically like a 65% probability, guy, and that's come down a bit.
Down significantly.
Yeah. So the cooler data that we get, and we've talked to a lot of smart people over the last few weeks or so, thinks that the market's got a little bit ahead of themselves a little bit. So I don't know. All right, let's so we don't get over our skis. Why don't we bring him in here? Because you and I think are both in the camp that earnings will hold the key. Here he is, John Butters. He's a senior earnings insight analyst over there at FactSet. John, welcome back to the program.
Great to be here. Thanks for having me back.
Hope you enjoyed Michigan, and congratulations on the Wolverines last night. And by the way, Dan Nathan's been on fire. But I said to Dan yesterday, and I've said it a couple times, that I didn't think Washington could score against Michigan. I thought the Michigan defense was stout. I'm not a fan of the Michigan quarterback. And quite frankly, as you know, John, he was not the story of that game. But I will tell you this. I think the quarterback of Washington, Penix Jr., he did not help himself in terms of draft positioning. And last night I said on Twitter, and you don't need to agree or disagree with this, but I thought the outside of Michigan, Drake May from North Carolina had the best night. But that's just me, John. Welcome to the show.
Well, I know my Patriots have a high draft pick for the first time in years, so I think Penix was on their radar. So we'll see how that all plays out. So
yeah, he's dropping off there a little bit. But John, you heard a little bit what we had to say about the market and kind of how it's been a tale of 2 weeks, let's call it, in the S&P 500 so far a little bit. I think a lot of folks were taking some profits last week, and some of the biggest names, some of the biggest contributors, not just to the performance in the S&P, but also obviously to S&P 500 earnings here. This week, they're coming right back for the stuff that got us there. If you look at the moves that we're seeing in like an NVIDIA and in, even the way that they're buying up, Google and Amazon today and stuff. So they're going back for the Mag 7. Talk to us a little bit how you're thinking about Q4 earnings season. We've seen some pre-announcements so far a little bit, but you have some data here that you're going to be dropping in your earnings insight blog this Friday morning.
Yeah, so coming into this earnings season, both companies and analysts were a little more pessimistic than normal in terms of their outlooks for earnings. So on the company side, 73 companies, the S&P 500 gave negative guidance. That's above the average. Typically, we see about 60. And in terms of the estimate revisions, analysts took the numbers down for this quarter by 7% during the quarter. And again, we typically see about a 3 to 4% decline during the course of the quarter. So as a result, look at the chart here. Back on September 30th, the expectations were for 8% growth. That's dropped all the way down to 1.3% growth as of today. But it is important to note, we're hanging in there for growth. And if we do get growth, which still looks likely at this point, that'll be the second straight quarter after we had 3 quarters of declines in late 2022 and early 23.
But what's interesting here, the speed with which analysts have ratcheted things down. And, that's sort of my takeaway. And Dan, we've talked about this as well, John, but I still think that earnings expectations for 24 still hover around 11.5 or sort of 12% year over year. And I'm hard pressed to believe that's going to come to fruition. But I guess it's somewhat encouraging to see sort of people, I want to say, come into their senses in terms of earnings expectations.
Well, yeah. And as I say, it's interesting to point out, while the Q4 numbers came down pretty dramatically, as you can see here, we haven't seen significant cuts yet to the first half of 2024 or the full year. So while the overall Q4 number came down 7% during that same time frame, all of 2024 only came down about 1.3%. So I think there'll be a lot of focus, as you guys alluded to earlier, the guidance, the outlooks, to where those numbers move going forward, because they haven't come down. They haven't come down over these last couple of weeks. And I know we'll probably get into this in a later segment, but the 2024 EPS has really been in a range of 245 to 250 most of this year. We've just dipped to the 244 point. But again, not a lot of downward revisions really during the course of the year for 2024. Not yet, anyway.
Yeah. So, John, it seems like since COVID, where a lot of companies kind of just abandoned giving forward guidance because of the lack of visibility, and rightfully so, at the time, we've seen the way, like, so to your point about this chart that you have up here, is like normal throughout the course of a quarter, you see 3 to 4% declines, right, in earnings estimates. And the fact that we're seeing greater than what we have in the past, it probably has something to do with the fact that fewer companies are willing to stick their necks out any further than they have to as far as visibility into their business. Does that play something into it? And do you expect that to be possibly a permanent change by a lot of S&P 500 companies, that they give less than they used to do prior to COVID?
Companies I think are typically conservative in their guidance overall, right? We generally see more negative pre-announcements than positive pre-announcements. I will say, coming out of COVID, we have seen a slight uptick in the number of companies giving guidance. So that number is starting to come back a little bit, but I think there's definitely some more conservatism, as you pointed out. And I think you'll definitely see, there's a good chance you'll see that this first quarter. I think at the start of the year, companies tend to be even more conservative. So it'll be interesting to see, when this guidance comes out and what sort of visibility it has. Is there no visibility? Is there good visibility?
Mm-hmm.
So we'll certainly, it's certainly something we'll keep an eye on during this earnings season.
You mentioned it, John, but let's look at your next slide, because visually people can see exactly what you're talking about in terms of the optimism and where we've been on the different, basically, calendar years and what we're setting up for this calendar year. Because, the words are one thing, but when you see the slide, and if we could sort of slide it, Earl, this isn't the one I was looking for. Actually, I'm sorry, man. It's the one. Thank you. That's the one. This one, to me, speaks volumes in terms of the things you were just talking about. So maybe drill down a bit here.
Yeah. So, we look at 2023, only about 220 expected in terms of earnings. We go to 224, about 244. But as we noted, analysts typically overestimate at the start of the year. And I think we sent you this guy's the chart a couple of weeks ago, but typically by 7%. So if you're at 244, if we take that 7%, typical reduction, that gets you down to 227, 228 here. But it is important to note that's an average. For example, for 223, we're only down about 5% from where expectations were at the start of the year, and it'll probably shrink even more once we get earnings season. Companies beat that 223 number, will probably come up a little bit. So, but yeah, the broader point is 11 to 12% growth. We haven't really seen much change in that expectation the last 6 to 8 months. I think this earnings season could be an inflection point. We'll start to get more guidance for 2024, and we'll start to see where these numbers move.
Yeah.
And Dan, I mentioned that real quick. I'm sorry, I mentioned that because when you see this visually, if you were to then have that reduction, so take 2024 down, and then over the last 3.5, 4 years, you effectively have flat in terms of earnings growth. I mean, within reason. So what are you talking about in terms of the market? It's all been multiple expansion, and that, Dan, is what's concerned me. But anyway, I wanted to visually show that because I think it makes a lot more sense.
Yeah, and we talked about that last night on Fast Money. We had a strategist on, Julian Emanuel from ISI, and again, that was the story of 2023, a year that obviously saw earnings that we don't have them all in yet, but expected to be up maybe at its highest, 0.5%, right, year over year from 2022. But it was the mirror opposite in performance. The S&P was down 22% in 2022, and it was up 23% in 2023, right? And the mirror opposite of what happened with earnings. So here we are now. We're coming in this year very near all-time highs in the S&P 500. We track your data that you are always looking at the multiple of the S&P versus the 5, the 10-year, and the 20-year averages. We're above all of them at this point, right? So if that 2024 number that we're not asking you to agree with us, but Guy and I think are very high, right, given the headwinds that we see to the U.S. economy, but also the global economy, then you have to assume that a few turns have to come out of the S&P trading very near 20 times, right? And so this is where I think it makes sense, though, also, John, to go back and look at from the sector level, right? The contributors to the S&P 500, because I think this chart that you have is really interesting, because here we have a little bit of a barbell here, right? So you're saying that the 6 sectors in the index that are expected to see growth are led by communication services, utilities, and consumer discretionary. Now, consumer discretionary and communication services are very interesting to me. Now, on the flip side of that, energy, healthcare, and materials to be a drag. Now, you can just add up all that you want on the drag versus the ones that are expected to be higher, there's going to be more room to the downside for communication services and consumer discretionary if we go into a recession, right? And that's the risk to S&P 500 earnings in 2024. Does that make sense the way I'm thinking about that, John?
Yeah, and if you look at the 2020, so this is Q4, but if we look at the 2024 sectors, it's those some of these same sectors are expected to lead growth next year as well. So it's communication services, consumer discretionary. We're talking about consumer discretionary. It's important about a lot of that's Amazon and the information technology sector. So those are the three sectors, if we look ahead to 2024, that are really expected to drive the earnings growth, in addition to a rebound in healthcare. So analysts are also expecting healthcare to rebound because the last couple of quarters it's been down as well. So, but yeah, those, if you're looking at earnings growth for 2024, those are the 3 to 4 sectors you'd want to focus on. They're expected to drive the growth. Again, communication services, information technology, consumer discretionary, and healthcare.
Well, they better, because one of the stats that I was reading last night, I want to say it was 75% of S&P 500 companies underperformed the S&P 500, which, if you think about it, speaks to to a large extent what we're looking at here. And we talk about it all the time, and we try to bring it to you in different formats, Dan. But again, it comes down to 10, 15 stocks that are literally driving this entire performance of the broader market. And when you have that type of disparity between the have and the have-nots, I mean, we probably haven't seen numbers like that in 3 or so decades, Dan. So that's why I look at this and understand, I get the numbers, but at a certain point, the math's just not going to work for a lot of these companies.
Well, listen, John, I think you know this. We appreciate your work. We track it every week. We get the preview of it on Market Call on Thursday. So we appreciate you being here with us on a Tuesday as we get into the bulk of Q4 earnings season, starting off at the end of the week with the financials. You had a great note on the Earnings Insight blog about Q4 and financials. People, you can find all of John and his whole team's great work at FactSet.com/subscribe. Get it to your inbox, and join the legend here, Guy, because that's really what's going on here with JB. And go blue. I think that's how you want to kind of take us out here.
I mean, without question. I mean, first of all, if there are any Butters family members out there saying, "What are you talking about, Michigan? We haven't been to Michigan." I know. I don't know what happened, but we went somehow from New Hampshire to Michigan.
Yeah,
I conflate them. Number one. Number two, when you talk about join the legend, I mean, it's like Paul Bunyan stuff now in terms of John Butters. So yes, join the legend. That is John Butters.
All right, John, we really appreciate you being here. Thanks so much, bud. You're a great sport too.
All right, great. Thanks for having me on. Appreciate it as always.
He's the man. He's the man. Hey, guys,
his work is great because when you can see when you visually see those, I think it helps so much just in terms of understanding what expectations are, where they've been, where we are. It's very helpful. As they say, a picture worth 1,000 words without question. And John's work speaks for itself. So we're fortunate to have him, and it's good to have him back. And we give him a hard time, but if we didn't give him a hard time, it would mean we didn't love him.
Yeah, we do love him. So check John's work out in your inbox. We appreciate it. Here, guys, this is something Doug Cass hits us from Real Money. You guys know him. We love him. Here's a great comment here. How do we get to 12% S&P EPS growth in 2024 if real GDP is only 1.5%?
Yeah, we don't.
And inflation is 2.5%, producing nominal GDP growth of only 4%. I mean, how is that math equation eluding all of those strategists who are still up there at $245 a share in S&P earnings for 2020? I just don't get it.
No, we've said it a number of times. The math doesn't work, and I'll tell you that the economy, I'm hard pressed to, in order for those numbers to work, the economy has to sort of escalate in a way that we've never seen historically. It's not going to happen, basically, is what the case is. So, you can make the case that, okay, you know what, maybe we're not going to get that earnings growth, but we're willing to pay more for $1 worth of earnings in terms of multiple expansion because the United States is head and shoulders above everybody else. And that has been a bull argument for a while, that there should be a higher multiple associated with it because of those things. I don't agree with that. I don't think you should be paying going to be north of 20 times for an economy that's basically going to slow down. And I don't think we're going to get this soft landing in terms of the employment picture. I think all these revisions at some point, and I think you have 10 months of negative revisions in terms of the employment numbers. It's got to come. It all has to come home to roost at some time. We're just sort of prolonging the inevitable, I think.
Yeah, so let's go back to the stock market for a second here. Let's look at the NASDAQ 100 futures, because this chart is kind of interesting. Looks a little different, Guy, than what we just kind of charted in the S&P 500. It almost checked back to that breakout level, right? So we saw how hard hit an Apple and some of these big tech names were last week, kind of light, low volume sort of stuff. Almost got back to that level. And I think that both you and I would have said, well, that's kind of the line in the sand a little bit. So it's still 16,000 is going to remain an important level to keep an eye on. And also, obviously, that prior high. Thoughts there, because again, it goes back to what you're talking about, is that, those 10 names are driving all the performance. So you can have a broadening out by a bunch of $10 billion market cap companies, right? It's not going to do a whole heck of a lot, especially because let's just throw up an NVIDIA chart for a second here. This is a $1.3 trillion market cap company that has gone up 10% in the last 2 trading days in a straight line. And so again, that just tells you the opportunity in the market, but also the risk in the market.
Yeah, put that NVIDIA chart up and keep an eye on, okay, so let's take a look at this chart. If we could throw a moving average in, Stephen or Jacob, thank you, and you'll see. So you saw the check back to the moving average, and if you could do it, I think we need a 150 or a 200. So you see the check back we had in terms of the NASDAQ in October. Well, we obviously didn't get there in terms of NVIDIA. Now you could see, again, a couple standard deviations away. Now, in real time, if you could throw up an Apple chart with a similar moving average, you'll see that we traded down and through it briefly in October, and we traded down to it to the penny, as Carter would say, last week or thereabouts. So this is a different chart, obviously, than the NASDAQ. So keep an eye on this. The Apple did trade down in the moving average and bounced. To your point, though, Dan, the NASDAQ has not, and that's in large part due to that prior chart we looked at in the form of NVIDIA. So a lot of things to like here. Yeah. And quite frankly, congratulations to you on Friday outlining, again, and Carter said it as well, the continued breakout in NVIDIA. But man, oh man, you look at that NASDAQ chart, just to sort of end with it real quick. I mean, it becomes concerning at a certain point when, you don't, again, you had that check back in October, but the farther we get away from the moving average, the more inclined I'm to believe we're going to revisit it at some point.
Yeah, and maybe they could throw up Microsoft while we're at it. So again, Apple and Microsoft, they seem to be sparring for, the largest market cap in the market, both, near 3 trillion. Look at that consolidation, Guy, over the last, couple month or so. And you could say, well, it's, on a relative strength basis, it's kind of underperforming the market. It's unchanged on the year right now. But much like that NVIDIA that corrected over time, right? It worked off that overbought condition over time. Microsoft might be setting up to do something not too different in a way. So again, if you're going to pull up the RSI, a 14-day, it doesn't look particularly overbought the way it did a month and a half ago when it was trading at the similar level. So that's one to keep an eye on. And again, this is one that I think you and I can both be in agreement. Next to NVIDIA, probably has the most investor enthusiasm around their generative AI opportunities here. But here's also a stock on 2024, the current fiscal year they're in, trading at 33 times, expected, mid to high teens growth as far as earnings and sales growth that, is also mid-teens or so. You could say on a relative, to its expected growth, not horrible, especially if you think there's upside to their numbers, right, based on Gen AI, but that's still, who knows, right? And so to me, it's about as expensive it has been towards itself, its history, in a very long time.
Agreed, 100% agreed. Apple as well. What's funny is people are starting to make a compelling case for NVIDIA in terms of valuation, but a lot has to happen. A lot has to go well for them moving forward for them to grow in that valuation. But one of the things we teased is some of the under the radar, under the surface problems in the tech sector. And, we throw a microchip. And again, we're not suggesting microchip is the broader market by any stretch of the imagination, but it's worth noting. Then you had Samsung, which we talked about last night, I think at 8:30, 9 o'clock. We went back and forth on text messages. So what we're seeing is in a couple different things. We're seeing the ramifications of double and triple ordering, number one, and the flip side, the ramifications of slowing demand. And that's manifesting itself in a number of different things. So we talked about it with Mobileye last week, microchip, Samsung, I think to a certain extent, Taiwan. So I mean, there's a laundry list of companies that have given us concerns, but it's being masked by the performance of, again, specifically NVIDIA and a handful of other names.
Yeah, and that microchip is interesting because as we were talking about it last night after the close, it was down 5% or so. It was down a little bit before the open today, and it bounced again right off of that moving average. So I think that's kind of interesting. And we had Dan Niles from the Satori Fund on last night. I've known Dan for as long as I've been in the business, and he's seen all these tech bubbles kind of inflate and burst. And I think he's a very sober guy and a really smart guy. He was on Fast Money with us last night, but I actually did guide nearly an hour with him on OK Computer, a Risk Reversal Media podcast that drops on Wednesday mornings. So people go follow that. That's going to drop tomorrow morning. You can find it in your podcast store. It's OKAY Computer. And Dan and I went through his top picks for 2024, and definitely a couple really surprising ones in the tech space, a couple in the biotech space. We talked about China a little bit, and then he also has a lot to say on semis. And to your point about the double and triple ordering that no doubt has been going on in the Gen AI data center space, and he's got a couple ways to play that. I thought that was really interesting. So tune in, Guy, for that. The Samsung is really interesting because that was a guide lower, and a lot of folks, we were talking about Apple a second ago. A lot of folks are worried about Apple. They're worried about what they're going to say, and given kind of how they guided last quarter, which wasn't particularly great, but the stock rallied a lot afterwards, and it really just got swept up in all the enthusiasm about the market. They don't even have a Gen AI product for all intents and purposes, Guy.
Well, they don't talk about it if they do. And obviously 3 downgrades last week sort of put a kibosh on things in the short term. But now, again, with money flows finding its way into the market, Apple wins to that. And I think that's why, to a certain extent, it's gotten itself off the mat as well. But I think your point is well taken. I mean, believe it or not, folks, Apple faces the same headwinds that a lot of other these companies find themselves in the midst of. And I don't think they're going to be impervious to it. So we're going to see. Listen, a lot's going to come home to roost moving forward. Right now, the market, everybody feels good about things. Money flows continue. The geopolitical risk is out there, but it's been out there for a while. So I think people are getting comfortable with it. In terms of bond volatility, it's there, but not nearly to the extent that we've seen it. So there are a lot of calming effects, but I think it's just masking some of the headwinds that we've talked about now seemingly forever.
Yeah, let's look at the macro here a little bit, because crude is one that we've been talking about. And again, it's a demand story and it seems to be weak. There's also an issue where you have, the Saudis cutting prices. I saw some stories about weak or lower Russian output. That would be towards China. As we know, you see that downtrend that's been in place. We're kind of butting up against it a little bit. But I guess, you and I don't, as far as the crude, I mean, like any sort of geopolitical sort of thing, and we're going to be right up at that 200-day moving average. Do you think crude is setting up? Like, do you want to play for a breakout here, Guy, at this point here? Because again, where to stop to the downside. I think it's probably, like the initial stop right here, if you want to keep it really tight, is kind of buying in this kind of 72 range and stopping down at 70. I don't know. Is that too tight right here to play for this?
It's
we're churning.
So, I mean, look, so this, and the chart speaks to this. Every time since September you've tried to play for a breakout, you have not been rewarded. You've actually been punished. So the question asked again is, why it's any different this time? So I will remain in the camp that, I do think higher prices come at some point on the back of a myriad of different things. But I think right now people are saying this is the demand story. And quite frankly, to a certain extent, supply as well. I mean, if you look at what's going on, you just mentioned the Saudis, U.S. production over 13 million barrels a day. That's obviously putting a bit of a lid on things here. But there will be a point where this trend line is broken and we trade back up to the moving average, and we're going to have a conversation about what got us there. But in the meantime, I think you just got to sit tight, Dan, and continue to do what you're doing. I mean, every rally's been an opportunity to sell it again.
Yeah, and it's interesting when you think of just this kind of 70 to 75 range here, we're churning, right? And so to do that with futures, you'd probably want to keep much tighter stops. And then the other thing, I'm just curious what your thought is here, Guy. Like if demand's weak, nothing's changing on demand anytime soon. So the only thing, in my opinion, in the near term, okay, is that basically gets crude to pop and it's going towards that moving average, okay, up there and maybe on its way to 80 or so, is something really bad geopolitically. And I actually just don't want to play for that because I don't know about you, man. Like there was enough bad shit last year. Like I think we're all kind of hoping things kind of tamp down a little bit. But is that it? Like literally, if you're playing for higher prices in crude right now, what is the catalyst for it to break out?
That is the catalyst. Some sort of escalation of some of the geopolitical events that we've been seeing for quite some time. So you're right. I mean, nobody wants to. You don't want to be right for those reasons, obviously, because if those reasons come to fruition, obviously something really bad is happening in the world. Nobody's wishing for that, but you can't just say it's not going to happen you can't just write it off and hope that it's not going to happen because, hope's not an investment thesis. But things are clearly being ratcheted up, and we won't talk about this probably until next week. But on the other side of the world, there's going to be an election this week in Taiwan that I think are going to capture the attention of a lot of people that nobody seems to talk about as well. So, yes, you're right to point out that geopolitical is what's probably, if there is a catalyst higher, it's going to be on the back of that.
Yeah, let's look at the oil service stocks for a second here. The OIH, the ETF that tracks them, and we know a couple of the names make up a lot. Look at that near term. We're right at that low from December or so. You see the well-defined downtrend, and what's interesting, Guy, is like a lot of room below. We're through the moving average here. We break those lows from just a few weeks ago, and you see that who knows, 250 is the next stop. But look at this. Pull up a 5-year chart, people, and we could just kind of visually look at the line that you would draw off of the sort of 2020 lows here on the OAH on a 5-year basis. And man, I mean, talk about coming up against a big support level here.
That's a huge trend line. I'm glad you brought that up because you can. I mean, we can have Steven or Jacob draw the line. They're good enough to do it now. But you draw the low from, I think, April of 2020, and you start connecting these lows, and you'll see exactly what we're looking at here. So there you go. I mean, you can fudge it a little bit if you want and sort of, but that's the trend line. I mean, Carter might be able to do a little bit of a better job, but
do it from the April low. Yeah, do it from the April low. I mean, it's not sitting on it right now. There's room to the downside, and it's 270 or so, guys. So you have another 6 or 7% until you're testing it. And again, if demand's weak, and then here's the flip side, Guy. Let's just say there's some ceasefire in Gaza, right? Let's just say there's nothing, that we get through this Jan 13 election in Taiwan, nothing's going on. Let's just say, there was a report, I think in one of the newspapers this morning about secret talks, peace talks that happened in December in Riyadh, in Saudi Arabia with Russia and Ukraine. And maybe it's just the Ukrainians, but it was the allies trying to get a sense for what conditions they might call for peace. You know what I mean? You would have crude much lower. I mean, like if there was and that would be a great thing. And it would be great for U.S. consumers for that matter. So this is one I think to keep a really tight eye on.
Absolutely. I mean, I think if the last one, I think we probably have a gold chart just for shits and giggles, as they say, because why not? But again, we're probably right at support again in terms of gold. And, the fact that the dollar's got off the mat a little bit, that's obviously not helping the cause. And there's your trend line. But this is what really concerns me. If we could do a real-time sort of 4 or 5 year chart and see the number of times we've basically traded up to this 2100-ish level and failed, I mean, it's getting to be a little disappointing now. So other than, there you go. So if this was anything but gold for me, I'd say, man, oh man, it just can't get out of its own way at these levels. You got to be a maniac to want to stay long. But I will continue to say that, it hangs in there, and I still think that it's going to have its day in the sun. So I'm just going to stick by that for now.
Yeah. All right. Before we get out of here, this is a good one. You were quoting this before, so you must have saw it. I know that you like this Twitter account. Doug also sent it to us earlier. This is the Kobayashi letter. And this is just how big have the Magnificent Seven become. The market cap of the Mag 7 is 4 times that of the Russell 2000. Microsoft alone is the size of the entire stock market of Canada. The market cap of the Mag 7 is the same size as the stock markets of the UK, Canada, and Japan combined. Pretty fascinating stuff there, Guy.
Well, look at the last line. Those stocks are the stock market. It's true. And again, in the world of passive investing, when money flows, they will just continue to sort of build on themselves, which is fine, except that, you can get yourself extended too. And when you have that, that few stocks carrying the load of everything else, and under the surface, all this damage is being done. You got to be concerned that if these stocks were to give it up for whatever reason, there's going to be a problem in the broader market.
No doubt. Okay. Well, listen, we try to come in this year a bit more constructive.
I know I'm energetic, man.
I didn't say anything about your energy level.
Yeah, I'm feeling it.
We're trying to, listen, new year, new possibilities. I'm trying to think about new narratives, but I'm stuck with one narrative that we were kind of harping on a good bit of Q4 and actually Q3 for that matter, is that 2024 earnings estimates, the consensus, are just out of whack with reality. I mean, it's just that simple. So I guess a lot of the work that Butters has been kind of detailing in the Earnings Insight blog over the last few months or so is that, while we just don't have this all at once clip to S&P 500 earnings, right? It happens kind of slowly, but I do think that maybe it's starting to happen a bit quicker. If you just look at the data that he started out his conversation with us with, is that normally over the course of a quarter, you'll see earnings come down 3 or 4%, the consensus, right? In the last quarter from September 30th for Q4, they came down 8%. So maybe that's something that is kind of, if we kind of come in line with that or actually underperform it, maybe that's one of the reasons why analysts start lowering the numbers quicker. So there it is, Guy.
Well, earnings season is upon us. We're going to hear from some people at the end of the week. So buckle up, as they say. And I've enjoyed this again, just to sort of finish where I started. I love the Rangers. I love their team. And if this was a year where we were rebuilding, I would be sort of, beside myself with enthusiasm. But this is a year, Dan, as I mentioned, that I plan on being one of the last two teams standing. And I don't like what I saw last night. So I know Peter Laviolette is a fan. I also know Chris Drew is a fan. If you're watching, still a couple pieces we need to put in place. But with that, we'll be back tomorrow. Tomorrow being Wednesday, if I'm not mistaken, EY from SoFi will be joining us. Is that correct?
She will. She's going to be a Wednesday regular, Guy, on the market call.
And I'll throw this in as well.
Yeah.
Because we did it last week. We sort of did a little overtime where we fielded questions in real time, and we'll probably effort that again tomorrow.
Let's do it. We're going to go OT with EY from SoFi. All right, everyone. Thanks so much. Thanks to our sponsors. Thanks to John Butters. We love having him on the program. Obviously, thanks to FactSet, CME Group. Thanks to all of you guys. We're going to take your questions tomorrow. Amanda is getting ready already, guys. So we'll see you tomorrow.
Later.